Hey everybody, it's Doug Shoemaker here with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. Each week, I'm going to break down what's happening with mortgage rates, housing, and the economy just the way you consume it best. So, if you're somebody who really just doesn't care how the clock's built and you just want to know what time it is, the next minute or so, it's probably for you. Now, if you'd like to know how the clock works, stick around just a little bit longer. We're going to give you enough additional information so that you'll have an understanding of what's affecting the market without feeling like you just got hit in the head with a clock. And then for my friends who really do like to know how the clock's built, I'm going to go ahead and give a little bit of a deep dive towards the end with enough detail to really start seeing the gears in motion and for you to understand how they all work together without getting a student loan bill. So let's go ahead and get started. But before we do that, if you're enjoying this weekly education and would like to actually help me keep producing it, please like and subscribe or share it with a home buyer or a real estate agent or anybody that you think would like to understand this sometimes complex data so that they can help themselves or others. Now, I really do appreciate all of you that have been sharing these videos and providing such great feedback. Your kind words, they really do make a big difference. All right, let's go ahead and get to it. So, mortgage rates mostly are holding steady to start the week, and that's even with a big jobs report coming out on Friday. Now, as of today, national averages from Mortgage News Daily have the 30-year fixed conventional around 6.16, the 15-year is around 5.75, the FHA 30-year is 5.79, the VA 30-year is 5.81, and the jumbo is around 6.35. Now, like I say every week, everybody, these are national averages. Your rate, it might be higher or lower depending on your credit, your equity, the loan type, your lender, and your overall strategy. Now, for refinance guidance this week, if you're 7% or higher on a conventional loan, or maybe 6.5% or higher for government loans like FHA or VA, it might be time for a conversation with a trusted advisor, like a certified mortgage advisor, at least somebody who won't twist your arm into refinancing way too early just so they can get a paycheck in their pocket, but also somebody who understands the market enough to counsel you on why waiting may be a bad idea if that's your case. And trust me, it might be, because I'm still seeing people all the time with 7.5% and 8% mortgage rates, even though they qualify for a refinance at something lower, because somebody told them to wait because rates might hit 5 point whatever the heck sometime this year. Now, if that's you, this is a judgment-free zone. Make sure and reach out so that we can talk about why that advice that you might be getting and might be functioning on might be costing you more than it's actually going to save you. All right, so last week the Fed they held the Fed funds rate steady, and that was at their first meeting of the year, and that was pretty widely expected. But home prices nationally, they also remain resilient, and buyer demand it's starting to improve as mortgage rates kind of ease off of recent highs. Now, this week, it's going to be all about jobs data. And JOLTS, which stands for Job Openings and Labor Turnover, that report's going to come out tomorrow. Now, ADP is actually a private payroll report. It gives an early snapshot of job growth or losses before the government's official report comes out on Wednesday. And the big employment report is going to be coming out on Friday. And that data is likely going to drive at least near-term rate movement. And that's the short version, everybody. So if that's helpful for you, I hope you'll share it with somebody else that it might help, and I hope to see you back next week. Now, for my friends that like to know how the clock works, let's go ahead and zoom out a little bit. The Fed actually held that Fed funds rate at 3.5 to 3.75, and that was after doing 3 cuts last year. Now, that part wasn't really surprising at all. What was notable is the decision, well, it wasn't unanimous. 2 Fed governors dissented, and another one, well, they wanted a quarter point rate cut. And that tells us that there's growing disagreement inside the Fed about how strong the economy really is, especially the labor market. Now, on the housing side, the data continues to show resilience. Case-Shiller, which is one of the most trusted and respected national home price indexes, it tracks how the price of the same homes changes over time. So it's a real price improvement, not just, hey, what are homes selling for this month? And it showed prices essentially flat month over month, but still showed them higher year over year. Now, the FHFA index, which tracks conventional mortgages, showed even stronger gains. A buyer demand, it's actually picked up as rates have eased. While builders, they just can't quickly enough add supply, and that's why waiting for both prices to drop and rates to drop at the same time has been such a bad strategy for so many people. Now, let's talk about the labor market because this is actually where the narrative and reality start to diverge a little bit. You're going to hear a lot of headlines saying that the labor market's strong because initial jobless claims are low and continuous claims, well, they look to be stable. The problem with that is that those numbers don't tell the full story. Initial jobless claims don't capture self employed workers or people who've been forced into the gig economy. They also miss people who chose not to file, including some immigrants who may be hesitant to interact with government systems at all right now. Now, continuing claims have their own issues, and in many states, unemployment benefits, well, they expire after about 16 to 21 weeks. And once those benefits expire, those individuals fall off the data completely, even though they're still unemployed. So if you add back people who've been unemployed for 27 weeks or more, the true number of continuing unemployed workers, it's closer to 3.8 million, not 1.9 million that you've been seeing in the headlines. And that's why labor market is weaker than a whole lot of people believe. So one Fed official who clearly understands this is Governor Christopher Waller, and he's one of the dissenters at the last meeting. He believes that the Fed's still too restrictive, that job growth in 2025 was actually overstated, and that after revisions, job creation for 2025 could be close to zero. Now, on inflation, he's actually pointed out that tariffs are accounting for a pretty meaningful portion of recent price pressures. And when you strip those out, inflation's actually pretty darn close to the Fed's 2% target. Now, his warning was pretty darn simple. If the Fed waits too long to act and the labor market deteriorates further, it becomes a lot harder to fix later. So now layer in a new development. President Trump has actually announced plans to nominate Kevin Warsh as the next Fed chair when Jerome Powell's term ends in May. And Warsh, he's historically been seen as kind of an inflation hawk. And what that means is that he's normally willing to keep rates higher and slow the economy if that's what it takes to rein in inflation. But more recently, he's actually argued that the Fed should move more quickly to cut rates. That signals a potential shift towards avoiding unnecessary economic restriction, especially if labor market weakness becomes more obvious. Now, markets don't wait for confirmation. They generally price in expectations early. That's why this transition at the Fed matters for mortgage rates over the next 6 to 12 months. Now, one other thing that I do want to mention, and this is firmly in the clock builder category, is some early discussion out of Washington around mortgage-backed securities. Now, there's been a lot of talk of roughly $200 billion in mortgage-backed securities, or MBS, support, and there's actually been requests to expand how much Fannie Mae and Freddie Mac are allowed to hold in terms of mortgage-backed securities. Now, this is important. I mean, nothing's been approved or funded or implemented. This is not QE, quantitative easing. It's not something that markets are trading on yet, at least not long term. We did see a couple days with some really big movement that disappeared literally the next day, but we've not seen anything long term. But it does tell you what policymakers are thinking. If the labor market weakens further or housing demand soften too much, mortgage liquidity, well, it's actually one of the first levers that they're going to be willing to pull. That does not mean rates are going to go down tomorrow. It doesn't mean they're going to crash. It means that housing is continuing to remain a protected sector. And that's very important for people who are a little uneasy about getting into the market right now. Now, from a technical standpoint, mortgage bonds, they're sitting right on that 25-day moving average, with the 50-day sitting right below it. Now, they're definitely stuck in a bit of a range for right now. And the 10-year Treasury, it's still battling that 200-day moving average. And this week's jobs data, especially Friday's report, it's likely going to be the decider on which direction we break into. But for now, we're going to be starting the week floating. We're going to stay flexible, and we're going to watch the data closely. If anything changes drastically, make sure you're continually watching the Shoemaker Loan Team on Facebook, as we'll get the updates posted there. So here's the bottom line for our first Monday in February 2026. The headline economy looks fine, but the underlying labor market, it's softer than most people realize. Policy, both current and future, well, it's starting to reflect that. And hey, if you're buying, refinancing, or you're just trying to make sense out of this market, strategy means a lot more now than rate watching. As always, everybody, I'm Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage. If you want a no-pressure strategy conversation, reach out. If you've applied somewhere else and you're confused or nervous because the lender just didn't demonstrate their knowledge of the industry or help guide you through any of these complexities in really any way, I'm always here for you. And remember, every loan that we close at the Shoemaker Loan Team, it helps local heroes through the Home Foundation. Have a great day, everybody. I'm Doug Shoemaker, and I hope to see you next week on 1 Minute Monday.